Mayuresh Joshi is with us as well. Mayuresh, good morning. Good to have you here. Just your thoughts on HUL. We know the numbers, but where does the stock go from here in your assessment?
Morning, Prashant. Again, the disappointment came through because of the volume growth for HUL, and clearly I think the personal products division did not live up to expectations in terms of what the street was looking at. Having said that, my own take is that, as the management was indicating, I think a lot of the input cost deflation has probably got into the EBITDA margin expansion. But what really hinges in terms of recovery would be how the rural economy fares out for HUL. And yes, I think it's a combination of both rural and urban for HUL across its product lines. But if the rural economy improves because of improved monsoons this time round, the volume growth can improve substantially. And again, I think the deflationary pressures that we're probably seeing, even in the soaps and detergent segment, that should slowly start fading away. But again, I think one really needs to give time, and you're going to see some earnings cut happening on an FY17 estimate, to say the least. But I think the demand recovery should start coming through if the monsoons are much better. And as expected, this time around, it would have a positive impact in terms of earnings pan out in the second half of this fiscal. However, valuations again at 42 odd times FY17 appear to be a headwind to HUL's premium justification in an environment like this. So clearly, I think how volume demand picks up in lieu of improved monsoon situation, along with competition picking up, I think all these factors need to be watched out. But in my opinion, I think valuations are a little bit on the higher side and will act as headwinds for the price of HUL at this point of time.
Where does Titan go from here?
No, again, Prashant, Titan has underperformed, right? Both the jewelries and the watches segment has not delivered up to expectations. If you take the full fiscal, the jewelry segment, in fact, the revenues are down 7.9%. Now, the Golden Harvest scheme that it has relaunched, the management is very, very hopeful to garner around 1,400 odd crores in FY17. And that can have some amount of positive impact in terms of how the top line for the jewelry segment grows. The kind of discounting that you probably saw in the watches segment, the eyewear segment, not coming up to the mark, and the other segments as well, which form a very small and minuscule component. I think they're not growing at the pace that one really expects. So I think in a subdued environment like this going ahead, my own take is that earnings are not going to improve substantially for a company like Titan. So in my opinion, I think the stock might underperform at least for the next 2 to 3 quarters.
You know, we're talking about numbers which have been disappointing and stocks which have gone the other way. We've talked about HUL and Titan. Here's another one, Walkhard. You know, it was up yesterday, it's up 2% today. Numbers have been poor, of course. Where does this one go? Mayuresh, that's for you, Walkhard.
So again, Prashant, I think one really needs to be very specific in the pharma space. It has got issues, and again, I think the entire recovery will hinge on how the FDA resolution has happened. Weak sales again, probably coming out of Europe and UK, US again being under stress because all the 3 plants, which were major suppliers to the US market, still under the resolution mechanism. So clearly, I think the timelines for resolutions will ensure that FY17 earnings do not come through for Walkhard. So it's a high-risk call that one really takes here, but I'm not willing to take that call at this point of time. I think there are other pharma companies which are valued at quite reasonable multiples, even from an FY17 perspective. So I think I'll go for the other pharma companies, not at Walkhard at this point of time.
Mayuresh, the so far earnings that you've seen, based on those earnings, are there any calls that you can take on stocks? Or you think, you know, where numbers have been good, expectations were high, and stocks are already factoring in the good news? Or are there any opportunities, any discrepancies between performance and where stocks are trading?
So largely, if you look at the pack, I think the larger private sector banks have given a reasonable performance. I mean, if you leave aside banks like Axis and ICICI, I think the stress was obviously expected to continue for these corporate stroke SME lenders. And again, I think the management commentary and transcript are suggesting that the kind of stress that one really expects would continue for the better part of FY17. The retail-oriented private banks have given a far better show. I think that show would continue for the better part of FY17. Retail advances have grown at a very decent pace. Asset quality has remained extremely stable for banks like NES, IndusInd, HDFC Bank. So I think the larger trade-off probably happens on the larger private sector banks, where our own expectations is earnings growth can be in excess of 20-22 odd%. However, valuations for a few of these banks probably overstretched at this point of time, so one needs to be stock specific on this front. IT, in my opinion, specifically large cap IT, did deliver, except for a few blips. What happened with Wipro, again, largely expected in terms of how the dollar guidance was expected to be, the EBIT guidance that HCL Tech gave. But again, I think the order book that HCL Tech is sitting on, the expectations of engineering expected to do well along with IMS, I think we remain extremely sanguine about how the IT sector might perform over the next 15 to 18 months as well. Cement as a theme has done exceedingly well, and in my opinion, again, utilization levels picking up, the kind of government focus specifically on infrastructure and housing expected to pick up at a much faster pace would ensure that volume growth picks up quite substantially over the next few quarters, which will entail that realizations pick up quite meaningfully, specifically in the northern and western parts of the country, and that will lead to improvement in the return ratios. Valuations, again, I think for a few companies a little bit stretched at this point of time, but as a theme, I think cement is something that I'll still continue to prefer, along with a select few auto ancillaries, where our own take is that with improved monsoon coming through, the rural demand coming back, the volume growth can be quite substantial in the second half of this fiscal, where Q1, Q2 might be a little bit of a tepid or a slow phase, specifically in terms of how volume growth pans out for a lot of auto and companies. So in a nutshell, I think results encouraging so far, but second half, I think where PSU banks, infrastructure, capital goods start reporting numbers, I think these numbers are not going to be that great, and I think the consolidated earnings will get dragged down as the market really expects.
Mayuresh, Sarvendra, thank you very much, both of you, for coming on. Great speaking with you gentlemen. Thank you for your time.
Thank you.
As always. Thank you. Let's just take a very quick break here. We'll come back in 2 minutes. The market is as flat as they come. I mean, there is about a 3.5 odd point change on the Sensex.